Hi, welcome back to Joe Blogs. In this episode, I want to talk to you about BlackRock. Now, BlackRock is the largest fund manager in the world. It currently has assets under management of around $9.7 trillion. So these guys are serious investors, and they're covering everything in the market. They are looking at absolutely every single aspect. And they've just produced their global outlook and have stated that the 40 years of great moderation that we've seen, where we've had stable growth and relatively stable inflation, is over, and we're now moving into a new era which requires a new playbook from their perspective. So they're changing their investment strategies and their outlook because they think that 2023 is going to be one of the most unstable years that we've seen for a long period, and that the dynamics in the market are changing entirely. So we'll look at the four drivers that they've identified, which are a new world order. So I'll talk to you about what exactly that means. An aging population, the move to clean energy, so away from fossil fuels towards renewables, and then the infrastructure gap as they've identified it. And then we'll look at what this means in terms of the views on inflation and their investment outlook for 2023. The things that they are looking at investing into and the things that they're pulling back from. So this should really give you more of a balanced perspective. BlackRock invests predominantly into equities and bonds. So this will give you a good flavour as to what you should be thinking about for your portfolio for 2023. And then finally today, once we've been through all of BlackRock's analysis, I'll give you my views as to what I think this means for 2023 and beyond. So let's waste no time at all and get started. The BlackRock Investment Institute has released its 2023 Global Outlook, and the opening remarks state that the Great Moderation, the 4-decade period of largely stable activity and inflation, is behind us. The new regime of greater macro and market volatility is playing out. A recession is foretold. Central banks are on course to over-tighten policy as they seek to tame inflation. As a result, BlackRock is deliberately staying underweight in equities, but expects to turn more positive on risk assets at some point in 2023. But they're not there yet. However, the expectation is that even when they do get there, they do not see sustained bull markets of the past. This is why a new investment playbook is needed. Now, these opening remarks are really interesting because fund managers don't chop and change their portfolios. Therefore, they're taking a longer term view. And usually when you see these annual reports, it's just a tweak here and there talking about maybe changing their sector focus or moving away from one area, moving into another, looking at things geographically. But what they're saying here is that there is a sea change happening. What's been happening for the last 40 years is no longer going to be the way forward. They think that things are changing materially. And obviously that's difficult from a fund manager's perspective because you can't just shift out of all of your assets. When you've got $9.7 trillion invested all around the world, most of that is going to remain in place. You may be able to tweak some parts of it, but you can't change everything whole scale because it will change markets. But this is really interesting news, I think, from BlackRock, that they think that things are materially moving for 2023. So why is BlackRock seeing this period being different to the end of any other financial year? Well, let's read a few more of their opening remarks. We laid out in our 2022 mid-year outlook why we had entered a new regime and are seeing it play out in persistent inflation and output volatility, central banks pushing policy rates up to levels that damage economic activity, rising bond yields and ongoing pressure on risk assets. Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. They are deliberately causing recessions by over-tightening policy to try to rein in inflation. That makes recession foretold. We see central banks eventually backing off from rate hikes as the economic damage becomes reality. We expect inflation to cool but stay persistently higher than central banks' targets of 2%. What matters most, we think, is how much of the economic damage is already reflected in market pricing. That is why pricing the damage is our first 2023 investment theme. Case in point, equity valuations don't yet reflect the damage ahead in our view. We will turn positive on equities when we think the damage is priced or our view of market risk sentiment changes. Yet we won't see this as a prelude to another decade-long bull market in stocks and bonds. So what BlackRock is saying here is very clear. In the past, central banks have been able to save the economy by adjusting interest rates, but they believe that that situation no longer exists and that central banks are actually causing the recession by raising interest rates at a time of volatile economic growth. And they believe that the damage has already been done, but that it's not yet reflected in equity values. And just to remind you, this is the largest investor in the world. They've got $9.7 trillion invested into equities everywhere. And if they believe that equity prices are overvalued, then I think everybody should sit up and listen to that, because these guys know what they're talking about. It doesn't matter if you're a fan of BlackRock or not. The facts are, these guys have got the most money of any single company invested into equities. And they are saying categorically that they believe equities are overpriced and they are now bearish on equities. They may change their view going forward, but for the foreseeable future, for the next 3 to 6 months or so, they believe that equity values are overpriced and are therefore likely to come down in value. And of course, the other statement that they've made here that's very clear is that a recession is foretold. So they're basically saying a recession is guaranteed to happen. And the biggest market that BlackRock follows is the USA. So what they're indicating here is that this isn't going to be a recession that happens in some minor countries around the world. They're expecting a recession to hit the USA and the rest of the world in 2023. Now, one of the drivers for a change in approach from BlackRock is that they believe that a new world order has been established. This chart plots BlackRock's global political risk indicator and is designed to plot the movements in geopolitical risk with higher scores reflecting higher risk. And you can see that they've highlighted 3 specific events over the course of the last 5 years: the declaration of the COVID-19 pandemic, the US presidential election, and Russia's invasion of Ukraine. In their report, BlackRock have stated that we have entered a new world order, which in their view is the most fraught global environment since World War II, a full break from the post-Cold War era. BlackRock sees geopolitical cooperation and globalization evolving into a fragmented world with competing blocs. And this change will come at the cost of economic efficiency. Sourcing goods locally will become costlier for firms, and BlackRock expects to see mismatches in supply and demand as resources are reallocated. A prime example of this is the response to Russia's invasion of Ukraine. Western sanctions have triggered a pursuit of economic self-sufficiency. Energy security is now a priority as Europe weans itself off Russian oil and gas, and we've seen energy shortages and higher prices. Strategic competition between the US and China has intensified, with a tough stance towards China being supported by Washington. The US is trying to restrict China's access to high-end technology, and China's recent Party Congress was a pivotal event, both politically and economically in our view. China looks set to de-emphasize economic growth as it pursues self-sufficiency in energy, food, and technology. We see slower growth compounded by the effects of an aging population over time. Geopolitical fragmentation is likely to foster a permanent risk premium across asset classes rather than only having a fleeting effect on markets as in the past. Market attention is likely to stay fixated on geopolitical risks. All this will likely contribute to a new regime of greater macro and market volatility and persistently higher inflation. So what BlackRock are saying here is that Russia's invasion of Ukraine isn't just another geopolitical event, another war that pops up, lasts for a period of time and then disappears. This is a sea change in terms of the way the globe is operating. They're looking at this as being a permanent breakaway from the interconnected world that we've had for the last 40 years. Russia has been part of that interconnected world. They integrated themselves following the breakup of the Soviet Union. But BlackRock's expectation is that that won't happen going forward. They think that Russia and probably China are going to separate themselves, maybe into a separate bloc or maybe independently, and that's going to cause volatility and increases in prices for the rest of the world because we're now going to have to become self-sufficient from a smaller pool of assets. This chart provided by BlackRock shows the participation rate of the US workforce dating back to 2008. The orange line shows the share of the US population aged 16 and over that is in work or actively looking for work. The yellow line shows how much the aging population has contributed to the decline in the participation rate since 2008. BlackRock's summary on this situation is that an aging population means a shrinking workforce. An ever-increasing share of the US population is aged 65 or over, which is the age when most leave the workforce. This is one key reason the supply of US labour is currently struggling to keep up with demand. Along with students and stay-at-home parents, retirees are outside the labour force, which is why the share of the adult population that's inside the labour force is still well below where it was before the COVID-19 pandemic began. And this is shown on the participation rate, the orange line on this graph. The initial drop in the participation rate in 2020 was driven by COVID shutdowns. However, many of the people who lost their jobs didn't look for another one right away due to healthcare worries or care responsibilities. As you can see, the orange line has recovered. However, the gap between the orange line and the yellow line is almost entirely down to aging. The increasing share of the population is of retirement age. And it's for this reason that BlackRock don't expect an improvement in the participation rate, and so no material easing of the worker shortage is likely in the near future. BlackRock is expecting that aging is bad news for future economic growth. The available workforce will expand much slower in coming years than it has in the past, and economies won't be able to produce as much. Aging populations don't consume substantially less either, particularly when you factor in healthcare demands, which means continued inflation pressure as reduced production capacity struggles to keep up with demand. Alongside this, BlackRock also see rising government expenditure on care for the elderly adding to debt. However, on a positive note, within equities, BlackRock are bullish on healthcare as a sector. This graph shows total annual investment in green energy between 2015 and 2021 for developed economies, emerging economies, and China, and it also shows the projected level for 2030. BlackRock's research suggests that global transition could accelerate, boosted by significant climate policy action, by technological progress reducing the cost of renewable energy, and by shifting society preferences as physical damage from climate change and its costs become more evident. Europe has intensified its efforts to build clean energy infrastructure as it seeks to wean itself off Russian energy, and further impetus is likely to come from higher traditional energy prices, which are exacerbating the cost of living crisis and have shifted the economics decisively in favour of cleaner energy resources. In the US, the Inflation Reduction Act is poised to unleash enormous investment. BlackRock see investment opportunities in the sector and believe that infrastructure is one way to play into that. However, the transition is set to add production constraints. Oil and gas will still be needed to meet future energy demand, and if high carbon production falls faster than low carbon alternatives are phased in, shortages could result, driving up prices and disrupting economic activity. The faster the transition, the more out of sync the handoff could be, meaning more volatile inflation and economic activity. So what BlackRock are saying here is very clear. There is a big push towards cleaner energy, particularly now in Europe because they're having to change all of their supply chains. And so this is really focusing the efforts on that clean energy drive. However, the problem with clean energy is that firstly, it could increase costs because it's more expensive in the short term. And secondly, it could cause shortages because if everybody decides that they want to go all in on clean energy, and then we have disruptions to the production of power, which we've seen all across the world over the last 12 months. We've seen droughts that have caused problems with hydroelectricity production. We've seen problems with regards to lower wind speeds. And we've also seen delays in the switch on of production. So there are some volatility issues that relate directly to a lot of the clean energy sources. And if we do move away from fossil fuels too quickly and leave ourselves short, then that could have a direct knock-on impact into the economy. And that's why BlackRock are concerned about what's likely to happen over the course of 2023, because we are in this transition period right now. This chart produced by BlackRock shows the level of investment into infrastructure in 50 countries around the world between 2007 and projected out until 2040. The orange line shows the current rate of investment and the yellow line tracks the projected need, so you can see that there is a difference between the two of these. The chart shows World Bank data pointing to a gap of around $15 trillion between existing investments and what's needed to meet global infrastructure demand over the coming decades. BlackRock believes infrastructure can help diversify returns and provide stable long-term cash flows, even with risks such as governments imposing artificial price caps amid political pressure. Infrastructure earnings are often less tied to economic cycles than corporate assets. Contracts can be long-term and span decades, and infrastructure assets can help hedge against inflation with fixed costs and price linked to inflation. So the message here from BlackRock is very clear. From an investment point of view, infrastructure represents an attractive asset class. However, the problem that the world is facing is that the investment into infrastructure isn't being done at the same rate as the need. So that means that there will be shortages and we won't see the development happening as quickly as expected. So this is going to slow down the progress of the global economy unless more is invested. But of course, these investment decisions are made at a government level. This isn't BlackRock investing into this infrastructure. They can buy shares in the companies or invest into the assets, but they're not actually supporting these programs. That's being done on a political level, and unless that ramps up, the world is going to see a slower rate of growth. This chart shows the actual movement in inflation in the USA dating back to 2020, which is shown by the red line. And the white line here is the consensus view from economists of the likely rate of inflation over the course of the next 2 years. BlackRock believes that the politics of inflation narrative is on the cusp of changing. The cycle of outsized rate hikes will stop without inflation being back on track to return fully to 2% targets. As the damage becomes clear, the politics of recession will take over, and central banks may be forced to stop tightening to prevent financial cracks from becoming floodgates, as seen in the UK when investors took fright of fiscal stimulus plans. BlackRock's view, therefore, is that even with a recession coming, they believe that everybody is going to have to learn to live with inflation. BlackRock sees inflation cooling as spending patterns normalise and energy prices relent, but they see it persisting above target policy levels in coming years. However, volatile and persistent inflation is not yet priced into the markets in BlackRock's view. As a result of this, BlackRock is staying overweight in inflation-linked bonds and like real assets. The old playbook principle that recession drives below target inflation and looser monetary policy is gone. In BlackRock's view, market expectations and economist forecasts have only recently started to appreciate that inflation will be more persistent. So once again, BlackRock are taking a very strong view here. They don't believe that the 2% target inflation rate for the US, the UK, and a variety of other countries around the world is achievable, and they think that inflation is likely to remain high over the course of the next few years. And of course, that will have implications for everything because they can't keep increasing interest rates with the goal of hitting a 2% inflation target if it's not working, because at some point it will destroy the economy. So at some point, central banks will need to take their foot off the accelerator. And what BlackRock are saying here is that everybody's slowly coming round to this realization. BlackRock are already there, and they believe that everybody else will get there at some point over the next 6 months or so. This chart shows the movement in yields of a 2-year US government bond, which is shown in orange, and a 10-year US government bond, which is shown in yellow. BlackRock currently prefer short-term government bonds for income, as US 2-year Treasury yields have soared above 10-year yields. They also like US agency mortgage-backed securities for their higher income because they offer some credit protection via the government's ownership of their issuers. With regards to equities, BlackRock believe recession isn't fully reflected in corporate earnings expectations or valuations, and disagree with market assumptions that central banks will eventually turn supportive with rate cuts. They are currently looking at sectoral opportunities from structural transitions such as healthcare amid ageing populations as a way to add granularity. However, generally they are staying underweight in this asset class. Among the cyclical stocks, BlackRock currently prefer energy and financials. They see energy sector earnings easing from historically elevated levels, yet holding up amid tight energy supply. And increases in interest rates bode well for bank profitability. They also like healthcare given appealing valuations and likely cash flow resilience during downturns. So what's the summary and conclusion today? Well, I wanted to post this video because BlackRock, as the biggest asset manager in the world with $9.7 trillion under management, are somebody that you need to listen to. Whether you like them or not, whether you're a supporter of BlackRock is irrelevant. These guys have a lot of people working in research. They've got a lot of skin in the game. So they need to keep ahead of the trend. They need to know what's going on to try to move ahead of what happens with prices. And what they're saying is that firstly, there is a guaranteed recession coming. It is foretold, according to BlackRock. So it's not just me that's saying it. It's not just me that's hoping for a recession, which a lot of people seem to put in the comments. I'm not hoping for a recession. I'm just sharing information with you. It's not just me. It's people like BlackRock are saying that they believe that the fundamentals for 2023 look likely that a recession is guaranteed to happen. So that's the first point that I wanted to record with you. The next point is that they believe that there is a complete change in the way that the globe is operating, and that change is likely to become permanent. So what's happening in Ukraine, Russia's invasion, has caused a major problem politically, and Russia is now siding itself with a number of other nations, and we're seeing almost a return to the old-fashioned Cold War era when we had the East and the West, and the two didn't really do any business together. It looks like, from BlackRock's opinion, that that's what's going to happen in the future, that we will see Russia, maybe China, distancing themselves from Western relationships, and therefore there will be changes to the supply chain, and that's likely to add cost, because one of the reasons that we had an integrated globe is that it's the best way to do things. If you've got someone who's a specialist or an area that can produce things very cheaply, then you should utilize that. That's the best way economically to move forward. But if we're going to move away from that arrangement, we're going to move away from commercial agreements and get more into political areas of discussion, then that will definitely cause prices to rise, will cause inflation, and will also cause shortages from time to time. Now, it's not guaranteed that that's going to happen. That's just what BlackRock's view is, and I'm sharing that with you, so I'm trying to stay neutral on these matters. But BlackRock's opinion, based on all of their ongoing analysis, is that they think that there is a permanent change coming in the world markets, and that the 40 years of global moderation that we've experienced is going to be over. The next point that they raised was the aging population. Now, this affects the developed world more than the emerging economies, because obviously in the developed world, we do have an aging population. And that is going to represent a real challenge for a lot of economies, because if you've got less people in the workforce, then obviously you've got less productivity. And at that point, you would have expected that you could outsource more, you could buy in more things. But if we're seeing a change to the global world order at the same time as an aging population is coming through, then that represents a double challenge, because it won't be as easy to just source things from elsewhere if you're not doing business with half of the globe. And then the final point that BlackRock raised was the move away from fossil fuels towards cleaner energy. Now, from a big picture perspective, cleaner energy makes sense from an environmental point of view, and that's what everybody wants in the long term. But the problem that we have is that fossil fuels, firstly, are a very convenient way of providing energy, and secondly, are relatively cheap. So the movement to clean energy is likely to cause both increases in prices and potential shortages depending on how quickly we make that transition. If politicians suddenly decide that they're focusing on emissions and environmental issues, then that could accelerate the movement away from fossil fuels, which by definition will drive inflation because prices will go up, and also could leave us short of power in a worst case scenario. So the overall summary of all of those factors from BlackRock's point of view is that they are currently quite bearish. They're looking at equities as being overpriced. They don't believe that current valuations factor in all of the issues that they've raised. And so BlackRock are looking to take a step back. They are looking to be underweight in equities at the moment because they think that prices are going to come down. Now, they could change their view, and obviously they have $9.7 trillion invested. So they've still got a lot of investment in the markets anyway. But in terms of new investment, putting in new money, they are sitting back. They're looking at short-term bonds as being the most attractive asset class, and they've picked out a couple of sectors, healthcare and energy, as areas where they think there could be some value. But overall, it's a relatively cautious approach from Blackstone, based upon their premise that in 2023, a recession is foretold. So hopefully you've enjoyed today's episode, you found it interesting and informative. If you've liked what I've said, please give me a thumbs up, and thanks for watching this video all the way through to the end.